So we know that if you're here today, you definitely want your plan to run smoothly. There are a million other places you could be, and I'm really excited that you're here today. So it always seems like there's not quite enough time to get everything done. So my name's Colleen Windham, as Elke said, and I'm a CPA here at Definiti Academy. So for this section, we are going to talk about getting your plan ready for 2025, kind of being ahead of the curve, and then also some tax planning tips that I have for you guys. So with that, let's get started. The first thing up on the screen is the first of 3 tax credits that we're going to talk about. It is the startup tax credit. Now, first disclaimer here is, yes, I'm a CPA, but I don't know the inner workings of your specific business. So with that being said, my suggestion to you is to say, hey, CPA who does my tax return, I think that this credit might work for me. Let's discuss. So the CPA will probably say, what are you talking about? And you refer them to Form 8881. It's going to be on like the next 4 slides if you miss it or need to take extra notes. But in this case, I'm going to refer you back to that. Basically, these are ideas of, as Dakota had said earlier, you guys are in the best position to know what's going on with your company. So the first one, pretty much all in the name, is the startup tax credit. So what is it? It's for small companies, which the IRS defines as generally less than 50 employees. With that, if you are in the small company group, you can actually get up to $5,000 as a tax credit. So not a deduction, but literally straight off your tax bill, which I think is awesome, and I highly recommend you take advantage of it if that works for the size of your company. If you are a little bit larger, you can definitely still take that tax credit, but it's a little bit more limited. However, if you're up to 100 employees, you could still get that $5,000. But the next question is, okay, Colleen, we talked about this credit. What can I spend it on? So the tax credit is good for anything to set up the plan. So getting things squared away with the record keeper, doing plan documents, and even employee education. Now, I would fully expect you to say, hey, Colleen, I know you're a CPA, but what strings are attached? I wouldn't say there's any strings, but there are definitely some guidelines. So with that, for each of the tax credits that we're going to talk about, so this one plus 2 more, there's going to be a little section on the slides that say, what do I need to be aware of? So this is the quick and dirty list of stuff to keep in mind when you're talking with your own CPA. Now, this credit is good for up to 3 tax years. So really, if you're a small plan spending money, you could get up to $15,000 off your tax bill. So this one is super valuable. It's not available for solo Ks. So that means you've got to have W-2 employees that are eligible for the plan. And as I'm going to say, and you're probably going to be really tired of it by the time I get to the end of my slides, Form 8881 is the form that your CPA will need to fill out to claim that credit for you. Next up is the employer contribution credit. This says if you put in employer contributions, so think safe harbor match is a great one, or profit sharing, or even discretionary match, you can get a tax credit back for that, up to $1,000 per employee, which this also sounds like a good deal. And, if you're maxing out yourself as an owner and you have to give contributions to your staff, this is a great way to help recoup some of that cost and still provide them a retirement benefit. So best of both worlds for sure. Now, this has the same split as the previous item, where 0 to 50 is you can get 100% up to $1,000, and for the 50 to 100, it's a little bit less, but could still cap at $1,000 per employee. This one is actually good for 5 years, which is awesome, gives you a little bit more flexibility, and it's based on a sliding scale. So with that, I'm not going to dive into all the nitty-gritty, not here to make you bored, but once again, I will circle back and say, please do talk with your CPA and take advantage of those credits if this applies and is something that you do every year. Last but not least, this is the easy one. So this is the auto enrollment credit. And you do not have to be a new plan. So if you were around since 1983, great, you can take advantage of this one too. As long as there's basically less than 100 employees, there's a $500 tax credit. Also on Form 8881, And this one I think is interesting because there's a lot of discussion with Secure 2.0, which, as Elke said, is coming tomorrow, but that will, lots of people adding automatic enrollment. This is a great credit that could be missed, and I don't want you to miss it. So it's good for 3 years once you start the automatic enrollment. So it's good for up to $1,500 spread over those 3 years. Now, with that being said, that was kind of the little tax planning section. And we're going to move over to the second part of the items to discuss, which were, hey, if I'm in a plan review with you, Colleen, what should we talk about? So all of these slides are based on things that I would suggest you chat with your RPC about. And if you have questions, please do connect with them. Definiti wants to be here to be a resource and help you do things right by your participants and get those business deductions as well. So if we were sitting across a Zoom and talking about what we should think about for the upcoming year, one of my questions to you would be, hey, has there been any ownership changes? Well, sometimes I'll get the, Colleen, I sold the business, that's what we're doing. A sale is just a sale, let's all move on. Well, for 401k plans, the IRS gets really picky. So we want to make sure that we're addressing any sales and matching what the intention of the sale was. So there are two main kinds, asset sales and stock sales. And usually, by far and large, when I'm discussing this with a client, it's going to be an asset sale, which basically means the old plan terminates, everybody goes into the new plan, and we're good to go. Now, stock sales also happen sometimes. I actually just had one of these recently. And the big, if I were with you, I would draw a giant star that says, you absolutely want to make sure you talk with your RPC before the sale. Because if not, due to some IRS rules, you'll be stuck with two plans, which generally is not the intention. So mergers and acquisitions are very complicated. Obviously, there's attorneys involved, and there's lots of things that make each one a little bit different from each other. So generally, these are just some questions to think about. And of course, please do call your RPC. So are both plans going to stay open? Sometimes people do keep them open for a variety of reasons. What was the intention with service crediting and eligibility? Did you want everyone to join the new plan? Did you want to make them wait? Are we closing out the old plan? Are we keeping it open? And the third part is the part that I discuss with plan sponsors all the time, which is, Colleen, I signed my termination amendment. I'm good to go. I told my RPC, let's be done. Well, the IRS says that you have to keep filing 5500s until the plan assets reach zero. So if the termination amendment takes 2 years to sign and get everybody paid out, that's 2 extra 5500s, which I don't want to bill you for. You want to get the money out of the plan. So I implore you, connect with your RPC and let's get it squared away timely to save you fees and headaches, because as I am sure, the 401k is not the only thing on your to-do list. So we want to make sure that everything's running smoothly. Next up are plan amendments. So plan amendments, if you're thinking, hey, Colleen, I want to change something on my plan, this is a great time to do it. Generally, for most plans, you need to have out the information 30 days before you do it. So sending out things by December 1st is going to be great timing for you for the new year. I thought of 4 things that you may want to consider as an amendment. First off is compensation. And I really like that Dakota chatted about it just a little bit earlier. It's already been covered in this session, that compensation can get a little bit tricky. So the question is, are all types of compensations being included in deferred op? And at first you'd be like, Colleen, of course they are. I give you my W-2s, that's what we're doing. Well, plan compensation is actually gross pay. So it is W-2, that matters, but there's also things that layer on top of W-2 box 5. And plan compensation is all pay. So think the thing on your payroll register, not just your W-2s. So things that can be included and excluded, bonuses, escort medical to owners, which is like imputed insurance costs, personal uses of auto, fringe benefits, etc. Everybody has different pay codes and different ways they handle these things. But once again, talking to your RPC to make sure what's in your plan document matches what you're doing is super important. Nobody wants to have to go through the IRS corrections. The next two kind of go hand in hand and are also big deals for Secure 2.0, which is auto enrollment and auto escalation. So that is who's being included in the plan if they don't make an election, and when, if any, will the amounts automatically increase. So if I join your plan at, let's say, 6%, next year, are you going to bump me to 7? Are you going to leave me at 6? What does that look like and when will it happen? Lastly, Dakota mentioned also about testing failures when she was talking about the calendar. So Safe Harbor, there's definitely Safe Harbor options to help you fail testing. Just because you failed a test this year doesn't mean you need to do that in the future to save yourself some headaches. So this is a great time to fix the plan and get it kind of more streamlined for 2025 so that you can focus on other things and not worry about a testing failure. So there are a ton of notices that are swirling around, which have been mentioned earlier today in Definiti Academy, but generally they're due by December 1st. So you're getting them now. I see things going out from record keepers all the time, and we're preparing the auto enrollment and safe harbor notices. So this slide is just a real quick summary of what's going out, because participants get things, they're like, what is this? What are we doing? We have all these acronyms. So here's kind of the quick list of the most common 4 notices. So a safe harbor notice, if that's your plan, is here's our company contribution and how you can sign up for the plan if you want. Automatic enrollment says, hey, Colleen, if you don't choose a number between 0 and 100, we will stick you in the plan at X%. And Secure 2.0 basically went through and said, hey, these are what the automatic enrollment criteria will be. The third one I think gets the most confusing, but it's really not scary, is the QDIA, so Qualified Default Investment Alternative, which basically says, if I'm in your plan and I haven't picked what mutual fund I want, when you send my contribution over to, John Hancock, Fidelity, Empower, whoever, where exactly is my money going to be invested? That's what those say. And then the last one is a fee disclosure, which was mentioned earlier, that says, hey, Colleen, for this mutual fund, it's going to cost this much, but if you would like to take money out of the plan, it's going to cost XYZ, usually $100 or $125. Not that a participant is going to be charged that. It's more like if they take advantage of the service, it costs X amount of money. So speaking of taking money out of a plan, this next slide is about getting everything square with Uncle Sam. So first off, we have 1099s, which if you are with a record keeper, so think basically anybody who sponsored Definiti Academy today, they are going to take care of the payouts. No problem there. If you have a pooled or brokerage account somewhere, just kind of a holding account, Definiti needs to know by basically the middle of December to get the 1099s ready. And why do we care? The IRS requires 1099-Rs for all distributions, whether they are cash paid to employees or even a rollover. So we want to make sure that we're getting them to the participants so they can file their own personal taxes. Next up are required minimum distributions. So if you could see my screen right now, behind this presentation, I have RMDs to work on. So they apply to most owners and their families, so big star right there, and terminated participants born before 1952. That is updated for Secure and basically accounts for all the Secure updates that were made. If the money isn't out generally by December, that's the general rule of thumb, it creates an excise tax for the participant. So you don't want to ever go to one of your terminated participants and say, hey, Colleen, you left 3 years ago and you forgot to take $20,000. And oh, by the way, you've got to pay a $2,000 excise tax. Never goes over well. So please do work with your RPC to get those paid out before the end of the year. The last one is more of a being proactive. Secure increased the limits and says for terminated employees. So once again, big star. If I'm still working for you, this does not apply. It's only terminated people. And their vested balance is less than $7,000, then they can be forced out of the plan, which kind of sounds harsh, but really it's sending them a check or saying, hey, Colleen, you're gone. I'm sending you to an IRA on your behalf. You can invest it however you want. So it's more like letting them be free to go off and invest their money outside the plan. Now, it reduces fiduciary liability because while I'm still in your plan, you're still responsible for my money. So we want to get those cleaned out to reduce costs, stay in compliance, and of course, reduce the plan sponsor liability. Next up is ERISA bonding. I get tons of questions of this every spring, so I wanted to prepare and get ready now. What is an ERISA fidelity bond? So it is insurance for your retirement plan, whether you have a cash balance combo plan or just a 401k. Is it the same as your regular insurance? No, it is not. I've had people email me all sorts of information about their insurance. Please don't do that. It is a specific kind of insurance designed to comply with ERISA. And why do you care? So on your 5500, there is a little line on the second page that says, do you have a bond and how much? If you check that no, that can create IRS audit triggers. So we always want to make sure we're having that marked yes, and then the amount put in. And in terms of how much you need, generally 10% of your plan assets up to $5,000. If you're a brand new startup plan, generally ERISA bonds are not sold in denominations smaller than 1,000. So I'm going to say 1,000 or up. Is it expensive? It is absolutely not. If you're paying more than like $500, you're probably buying other things you don't need. And yes, you do need it, but Definiti can't sell it to you. We are not in the insurance business. However, we do recommend Colonial Surety. They are a bonding company that specializes in ERISA bonds. You can do it online. It's super easy, and your RPC can provide you the information if you need to get a bond. Last but not least is kind of my potpourri slide of things that I would definitely make sure to chat with you about during a plan review, but aren't big enough to discuss like a bond. Have there been any changes in your point of contact? So I usually work with HR managers and owners of the company. So if there's been an update, someone's been promoted, changed around, moved up to a new role, do I know them and do they know me so that we can get things done quickly and efficiently in the new year? Next up would be, are we being comfortable with the plan sponsor link, which is the online portal? First of all, we care about your data and keeping it safe, and that is a secure way to send us things. If you don't feel comfortable, let your RPC walk you through, help you fix whatever's going on there, because no one wants to be running around on February 8th trying to upload a census, and we're stressed and you're stressed, and we just want to avoid all that. We want to make this a clean and seamless process for you interacting with us here at Definiti. As was mentioned earlier by Dakota, is if there's any testing failures, have those been addressed? They definitely can be avoided. The plan does not need to fail every single year. And it doesn't mean that anyone's bad or wrong if a test fails. It just means it fell outside the IRS rules and we need to fix it. There's all kinds of planning that can be done to get that clean and smooth moving forward. And that way there's no headaches. This ties into the next bullet point, which says, is your plan top heavy? And you would know if your plan was top heavy because your RPC will tell you. So if you've never heard that term before, don't worry about it. It's basically where I'm going to say the owners, kind of as an overarching statement, own more than 60% of the plan. If they do, there's special testing considerations to take into play, and it's a conversation you want to have with your RPC to make sure that any items related to that are addressed. This one I see happen all the time is, were deferrals and loan payments timely? There is an IRS safe harbor that says if your plan has 100 or less, as you can tell from the tax credits, they love the number 100, is if that's your amount. So participants less than 100, you get 7 business days. If you have more than 100 participants, as Dakota mentions, it is as fast as you can do it, generally when tax payments are withheld from the plan or from the paychecks. If this is hard, sometimes I know, especially in smaller firms, the HR person is wearing 13 different hats. There's a lot going on. Definiti offers a 316 service, which basically just means we can help you with the contributions to keep them timely. So I think the discussion point would be, hey, RPC, we want to give this to Definiti to be compliant. What does that look like? Can we set it up and can we get a quote? Last two items are related generally to audits and keeping the plan clean. Is if you have more than 100 participants with balances, so that's the star that got updated with Secure, you're going to need an audit most likely. Auditors, that's actually where I came from and why I'm a CPA. I used to audit employee benefit plans. And the schedules for getting me as a CPA on your plan to do your audit fill up months in advance. So you want to make sure that you're getting on the calendar now, not trying to contact them in April and get an engagement letter. Last but not least is your forfeiture balance. Do you have any money in suspense, and are you ready to get that balance to zero by year end? If not, your RPC can help. So we noticed that I haven't really dove into Secure 2.0, and that is because Secure 2.0 is coming tomorrow as part of the Definiti Academy. So things like automatic enrollment, long-term part-time, contributions as Roth, and even new distribution options are all going to be discussed tomorrow on a panel. They're great things to think about and items that you could plan with your RPC to discuss. With that being said, I know working with many clients, we are a partner. So we know you've got a lot going on and there's so many things to juggle and keep in the air, whether you're the owner or in HR. So we want to partner with you to listen to those questions and concerns and then help you pick the best fit for your company and your employees.